in the US, we are very heavily where North America, where many cases are there. And then the situation in Australia and New Zealand, where there are confirmed cases, China and Korea the same, but where we know that the efforts to flatten the curve, as they say, have begun to succeed. Next slide, please. So if you look at the sub-Saharan African situation, Nigeria is actually way better off than most sub-Saharan African countries. It is the dark blue in the bottom part of the slide. The light blue, which is South Africa, is dominating, and followed by Ghana, really interestingly, Ghana. And then you also have many cases in Senegal, but by and large, at this point, not too many cases, at least, but that may also be because of under-testing. If you look at the number of tests per 1 million people, Nigeria is very low compared to even other countries in the region. You have about 131 tests per 1 million people in Nigeria, compared to 518 in Cote d'Ivoire, 5,000 in Ghana, and 6,000 in South Africa. So, which brings me back to the what I said at the beginning, the uncertainty. We don't know at the moment, how widely spread the virus is in Nigeria, because the testing has just not proceeded at that pace. Now, coming now to the economic part of the analysis, you look at sub-Saharan Africa. We are looking at the moment, and that changes almost every week, that GDP growth for sub-Saharan Africa will, as a whole, will decline to about 2.1%. The original versus 2.4% in 2019, a significant decline, but it could very well be also for a decline of 5%. And so this is again the uncertainty. We don't know how long this crisis will last. And obviously, there are many other issues that sub-Saharan Africa faces, especially Eastern Africa right now, the desert, the low-cost emergency, the drought, other conflicts, underdeveloped food markets, and all of this is being compounded by the COVID-19 crisis. There is also a serious concern that this COVID-19 outbreak could create a severe food security crisis in Africa because of the contraction in agricultural production by, right now estimated 2.6%. Optimistic scenario, 7% in the scenario with trade blockages. Now, from the macroeconomic point of view, fiscal deficit and current account deficits are going to increase. We will have more debt. And that comes at a time where many countries have already had a significant increase in debt and are facing issues as far as debt sustainability is concerned. This will likely become worse and will lead to calls for debt restructuring in various fora. Now, if you look at the way the pandemic is impacting, there are three main channels. One is the trade and value chains, particularly affecting commodity exporters and countries with a strong value chain participation, such as Ethiopia and Kenya, but also in West Africa, Cote d'Ivoire, a major exporter of cashew nuts, Ghana, cocoa, and Nigeria, of course, also cocoa. Now, here there is a bit of a silver lining, I would say. As you might know, China and Vietnam have recently opened up their markets and have started importing again. Also India. That is very important. It has manifested itself in increasing prices. For example, cashew nuts is now a significant increase. Cocoa is also increasing. Lastly, the gold price, for example, which is important commodity for many African countries, especially Mali and Burkina, has increased as well, which is a positive thing, especially in combination for the lower oil price, which of course is the major problem for Nigeria, but which is very favorable development for many African countries. If the commodity price exports are increasing, while at the same time the price of oil continues to be low, that is something that could buffer a little bit the impact of this COVID crisis. Now, the second part is reduced foreign financing in the form of lower FDI. right now very little investment is taking place. Remittances, capital flows, they are all, there's a problem there because many workers in countries that normally receive remittances are actually coming home or are not able to work in those countries. And lastly, here's something that we have as a very important issue for Nigeria also, the containment measures that lead to disruptions to domestic demand. So, so I think these are the three main transmission channels. And now coming specifically to Nigeria. The chart on the right side shows Nigeria's growth pattern. We have known that for a long time, that since the collapse of the oil price, Nigeria's growth performance has not been very strong. Of course, Nigeria was on a path of mild recovery following the 2016 recession. But that, of course, is something that is currently not in the picture. The latest projection is about -3%. Jesmin will know this those better. We are assuming right now, and that projection of contraction by 3%, oil price of about $30, and a relatively contained COVID-19 spread in Nigeria. There will be a contraction in the non-oil economy, and we only expect agriculture to contribute positively to growth in 2020. Now, if you compare the macroeconomic situation now compared to the last, when Nigeria entered recession in 2015-16, when these oil prices fell very sharply, it is very grave because debt has increased, and there are the overall the excess crude account, right, the reserves are no longer there. So Nigeria is less prepared to face this crisis than it was before, and even compared to the global financial crisis in 2010. Now again, lower crude oil prices is the primary transition channel to the Nigerian economy. Oil accounts for over 90% of exports, half of government revenues, and also the non-oil economy is very dependent on oil prices. And lastly, foreign portfolio investors' reassessment of risks could affect the capital flows needed to sustain the exchange rate. Now, we have, looking at the debt sustainability situation, the next slide. Andrew, lower revenues affect debt sustainability. At the moment, at around with a sharp decline in crude oil prices, the general government revenue could fall to about 4.6% of GDP in 2020, versus 7.7% of GDP in 2019. Large fiscal deficits coupled with constraints, particularly external borrowing limits, may compress public investment. And public interest payment could sharply increase. That is important for 2% of GDP in 2019 to 3% of GDP in 2022. Overall, 60% of revenue would be devoted to interest payments. That could be even more. And Fitch has already downgraded its rating to B from B+. Now, the other thing is, of course, that a plunge in oil prices will hurt the current account. Nigeria has limited buffers. The excess crude account is depleted, and the exchange rate is under pressure. Of course, the CBN has already acted to devalue the official exchange rate. But external reserves remain highly reliant on short-term inflows, which have been affected by rising risk aversion. Short-term portfolio investments were more than 70% of reserves as of December 2019. And another problem is that the oil price right now is so low that it is lower than the break-even point. The break-even point for Nigeria now is about $25, I'm well informed. So if oil prices hover around that level, $25, then it will be, I think some operators in the oil industry may find it hard to do new investments, new explorations in the oil industry. That could be, and that of course would increase further pressure on the current account. Lastly, of course, there is the question of how inflation will react. We have had the border closure announced in August 2019 to reduce smuggling and address security concerns. That has contributed to the rising inflation. Now, at the moment, the picture for inflation is unclear because since aggregate demand is not very high and is being depressed by the crisis, this will also have an effect on inflation. How the net effect will pan out of these efforts to, for example, to print money, the CB and overdraft, and the depressed demand on the other side is not entirely clear. But certainly there is possibility that inflation will also increase. Now, what does all of this mean? The last slide for Nigeria. We have been saying, the World Bank has been saying, and Nigerian policymakers have been saying this for a very long time, that Nigeria needs to break its dependency on oil, and this has never been more urgent than today. And the share of FDI into sub-Saharan Africa has diminished. And even though there has been a lot of improvement in the business environment, right, ranks 131 now out of 190 countries, it is still well below peers in some countries in East Africa, for example. Now, Nigeria has considerable potential to build its manufacturing sector, and that also includes areas for import substitution. Here, there is another thought that comes to mind. Many people say that with the current crisis, there is going to be an impact on the globalization. People might choose to produce more domestically within their countries. The long distance of transporting inputs and products and so on is something that is becoming out of more difficult to do. Here, I think there is a possibility to look at strategies for import substitution. Nigeria is, in principle, very competitive. Wages are low. The inputs are available, especially on the agriculture side, but also on natural resources like mining, gold, iron ore, tin mining, and so on. All of this is there, and there is huge demand. If one just looks at the southwestern corner of Nigeria, where there are large agglomerations of people, including those in the middle classes. And one area is that there are many countries that want to get away from labor-intensive manufacturing, such as China, for example, are interested in investing in Nigeria, industrial parks, and develop local production there. I think this is an opportunity that must not be missed. India has been doing this as well. They have been creating the terrain for Chinese investors, for example. And this is, I think, something that one could look at, how one can reinforce the momentum here. Because right now it is very, very important for Nigeria to build its manufacturing base and to really bring to fruition the various initiatives that have been done, have already been launched by many governors, many states. Let me stop there. Thank you.
Thank you so much, Volker. For those who joined us after we began, you've been listening to Volker Treichel, who's the chief economist for the IFC in West and Central Africa. A sobering picture. I mean, I'm sure we're going to have questions about that. I'm Andrew Nevin, founding director of the Africa Institute for Leadership and Public Administration. Thank you so much, and I'll put on my video. Thank you so much for joining us today. I'm going to introduce our second speaker. We're very privileged today to have Dr. Jesmin Rahman. Dr. Rahman is, sorry, trying to get a better picture. There we go. Better picture of me. Dr. Rahman is newly in post. She's the senior representative of the IMF to Nigeria, in post since May the 1st. She replaces Dr. Amin Mati, who served Nigeria very well, I believe, for more than 4 years. And thank you to Dr. Mati for his incredible contribution on that. And welcome to Jesmin to Nigeria. She'll also be speaking from the perspective of the IMF on these economic issues. Jesmin, can you hear me? Jesmin?
Yeah.
Okay. Are you able to sorry for everyone, and we're all trying to cope with new technology to do our work. Jesmin, are you able to put up onto the screen, share your screen with your presentation?
It says Sorry, can you hear me?
Yes, Jesmin, we can hear you. And while we're waiting, also just I think we're obviously going to take questions.
Okay, yeah.
And please put the questions in the chat box, not the Q&A. It's a little easier for us to deal with. So when Jesmin's finished, about 10 or 12 minutes, I'll be looking at the questions and going back to our panelists today for a discussion. Jesmin, can you share your screen?
Yeah, it's not sharing. Sorry.
All right, I'm going to try to share my screen with Jesmin's presentation if people are.
Let me see.
Oh, there we go.
Okay,
well done.
Very good. Thank you. Good afternoon, and thank you very much for the opportunity to be part of this webinar. I will, like Volker, start with an overview of recent developments in Sub-Saharan Africa first, and then move to more Nigeria-specific discussions. So let me start with the general picture. Over the past 2 decades, the region has made steady progress in meeting development gains. In this chart, you can see what happened to GDP per capita. And the blue line here is for non-resource intensive countries. You can see that there are sustained gains in income per capita. For the resource intensive countries, there was gains since until 2014. After that, there has been some bifurcation. And currently, this unprecedented health crisis and its economic fallout is risking a reversal of all the development gains. Here you can see on the health side, the pandemic is spreading rapidly in Sub-Saharan Africa, with most countries having been affected. Here we have the statistics as of May 10.
Uma, I'm sorry.
Sorry? Can you hear me?
Sorry, Jesmin, please continue, yes.
Oh, okay, sorry. So as of May 10, 2020, we have over 37,000 cases. And the region is really ill prepared to cope with this shock. In this chart, you can see that in Sub-Saharan Africa, per capita health spending is very low, a fraction of what it is in OECD countries. Africa is particularly vulnerable due to weak healthcare systems, widespread lack of basic sanitation services, and a large share of the population living with pre-existing conditions. And for the most vulnerable, social distancing is not really not a viable option. Working from home is also limited with a large informal economy in most of these countries. So, and with social safety nets either thin or very stretched, the impact on the vulnerable is going to be very, very large. So that's on the health side. Let me now move to more economic side. The economic impact of the pandemic is already being felt. Here you have the purchasing managers indices for major African countries. And this basically shows the direction of trends in manufacturing and services sectors, the sectors that employ the most. Below 50 means that we are in contraction territory. The April data, the last observation here, shows that basically a huge plunge across the continent. So, so the impact is already being felt. The next slide shows the IMF projection for GDP growth for 2020. And you can see we are projecting a contraction of 1.6%. This is the worst reading on record. Real per capita income will fall even more, 3.9%. Now it's important to stress the uncertainties of this projection that Volker also mentioned. And more importantly, these assumptions, these projections are based on the assumption that in the second half of the year, we will have the pandemic fading away and much of the restrictions lifted. Now it's looking more and more that that may not be the case. Also, these projections are based on oil price of $35 per barrel. That's not going to happen either. So, very likely we will see much larger GDP contraction. And what's really remarkable about this crisis is that unlike previous crises, every country is affected. So this chart shows you the growth revision in 2020 growth projection, pre-COVID and post-COVID. And these are the countries across Africa. Everybody is affected, ranging from downward growth revision of 2 percentage points to 14 percentage points. So, nobody is spared. There are essentially 4 channels through which sub-Saharan African countries are being affected. The first one is domestic containment and mitigation measures. These are very important to slow down the spread, but it does a number on the domestic activities. The second is plummeting global demand. IMF projections shows that global growth is projected to decline by 3% in 2020 with large downside risks. And this will affect exports, remittances, tourism, but also possibly inflation if food imports are affected. The third channel is tighter external financial conditions. Many countries have seen their market access drying up with sovereign spreads reaching all-time highs. Foreign investors have withdrawn an unprecedented 4.7 billion from the region since the end of February. This is the fastest outflow on record. And the fourth channel is, of course, declining commodity prices, particularly oil. Oil prices have halved since February, plunging to 18-year low. Other commodity prices are also touched, apart from some precious metals like gold. So essentially, the continent is being affected from all sides. Let me now turn to Nigeria. Now, Nigeria entered this crisis with pre-existing weaknesses. The first chart here shows real GDP growth in the last 3 years since the 2015-16 commodity price shock. As you can see, Nigeria's growth in black diamond has been much lower than emerging market country peers' growth rate. And it's also, of course, also below Nigeria's population growth. So on a per capita basis, income has shrunken. As the economy transitioned to a world where demand for oil was lower, the non-oil sector did not really show a robust pickup, and this is why you have seen the low growth. And the low growth, in turn, is a result, partly, among other things, is very low private investment. That's the right-hand side chart. Low confidence, policy uncertainties, and governance weaknesses have kept private sector investment low for a long time. Now let's move to fiscal. This lack of vibrant non-oil sector has also constrained fiscal policy space. The left-hand side chart shows you government revenue and expenditure. You can see that during 2015-2016, the oil price, the commodity shock, the revenues went down. But what's important to see is that after that, there was no pickup, which means that the lost revenue from oil was not compensated by non-oil revenues. In fact, Nigeria has one of the lowest VAT collections in the world, much lower than ECOWAS peers, reflecting both a low rate and low compliance. Total revenues, oil and non-oil, were a mere 8% of GDP in 2019. So even though public debt itself is not high, because of low revenues, over 60% of federal government's revenues are spent on interest payments. This year, because of sharp decline in oil revenues, this ratio is expected to rise to 100%. What that means is that after servicing debt, the government will have to borrow for any and every expenditure. This point about Nigeria not collecting enough revenues and low domestic revenue mobilization cannot be overemphasized, given the large social and infrastructure investment needs of the country. In addition, Volker had also mentioned that the excess crude reserve is depleted. So the government or the country entered the crisis in a very weak position compared to previous crises. So not surprisingly, Nigeria has been battered by the current crisis, particularly through two channels: the plunging oil prices and the financial flow channels. On the left, we have a short table on key economic vitals. Real GDP is projected to contract by 3.4% this year. This is a revision of 6 percentage points relative to our pre-COVID-19 projections. And both fiscal and current account deficits are also projected to widen significantly. And if oil prices stay low, these projections will all see downward revisions. On the right-hand side, you can see impact on assets, financial market, very large increase in CDS default swaps and Eurobond yields, both above 600 basis points. There has been also a large outflow of portfolio holdings, as well as a decline in share prices. So a bit on what the government is doing to help with the health crisis. The government has taken significant health measures to cushion the impact of COVID-19. Here you have kind of a list, both on the health side as well as on helping businesses, cash-constrained households, to counter this crisis. But because of the limited fiscal space, what we are seeing is that the fiscal financing needs have increased. The right-hand side table shows you pre-COVID and post-COVID financing needs. And this is really just coming from huge plunge drop in revenues. So even though the government has actually removed fuel subsidies and reprioritized some of the expenditures, so there has been some domestic adjustment, but even with all that, financing needs have gone up. Most of these needs are being made domestically, as well as resources from IFIs like the World Bank, IMF, etc. So that's in a nutshell the situation in Nigeria. I'll stop here.
Thank you so much, Jesmin. You've been listening to those who may have joined us while Jesmin was speaking. You've been listening to Dr. Jesmin Rahman, who is the newly appointed senior representative from the IMF to Nigeria. Welcome. I'm Andrew Nevin, part of the Africa Institute for Leadership and Public Administration. Earlier on, we had Volker Treichel speak, who is the senior economist for the IFC for West and Central Africa. We now have some very good questions that have come up in the chat box. So let me do my moderator role and play that. And first question from S, which is well, I think a wonderful name, S. How long are this prolonged disruption likely to go on in Nigeria and Africa? Are we looking at a V-shaped recovery, a U-shaped recovery, an L-shaped recovery? And how many years are we going to be in this economic pain? So Volker, let me start with you on that question. And Volker, you have to unmute, I think. Well, we seem to have lost Volker. Jesmin,
yeah.
Are you able to address that question? What's
Sure.
the IMF's view on how long that this disruption is going to take?
So IMF's current baseline, which you saw in the April World Economic Outlook, is a V-shaped recovery. So basically we were assuming, or we are still assuming, that second half of the year we'll see activities returning and the pandemic fading away. I guess we are leaning more and more towards a U-shaped recovery, meaning that the weaknesses continue this year and possibly early next year before you see gradually real GDP coming back, not to its 2019 level, not before 2022 or 2023. So does that answer your question?
It does. So we're expecting reduction in GDP this year and some mild recovery in 2021 is the IMF's viewpoint. But to get back to 2019 will take till 2022.
That's right.
Volker, do we have you? No. Okay. So then the next question, Tony asked a very good question, is, isn't the reduction in oil price a positive for the country if it takes advantage of it? What's the IMF's view on the role the oil price plunge is going to have in kind of causing an economic restructuring ultimately in Nigeria?
You mean like the government being forced to do some reform? Is that the
Well,
angle?
you've just put up, you've still got your slide up there that says gross financing needs are 14 trillion naira, which is about
Right.
10% of GDP. There presumably has to be some reaction to this. I mean, in the end, is the oil price plunge going to be a positive for the future of Nigeria?
You know, this is not the first oil price crisis that Nigeria has gone through. But it's definitely the one that has caught the government with the least policy space, right? So in that sense, the urgency of adjustment is definitely higher. And you have started to see that because, for example, fuel price subsidies, you know, this is a hole in the budget. They have eliminated. And in our, IMF has just disbursed a rapid financing loan to Nigeria. And in that part of that loan, you know, the government commits to keeping this subsidy, maintaining this removal of, or removing this subsidy for good. So that's a positive. They're also thinking of electricity tariff reforms. And all of this sort of with the intention to create fiscal space. So there are some reforms going on. On balance, whether we need such a, you know, one has to keep in mind that oil is such a vital part of Nigerian economy, both for fiscal revenue and even more importantly, foreign exchange reserves, that a prolonged period of weaknesses, you know, will definitely do a lot of harm to the country. And in that short-term period of time, especially in a COVID-19 situation where, you know, there are a lot of constraints on domestic activities, you know, pushing reform, this may not be the ideal time, you know, let's say to start revenue mobilization, you know, through tax policies and etc. So government's, you know, ability will be constrained too.
Yeah, that's very interesting. So what Jesmin is saying there is that while we have the FIRS and other tax authorities putting pressure on the system to raise more tax, to try to raise more tax in the middle of the most severe recession in our lifetime may be counterproductive on that.
That's
okay,
right.
so Edith has a question here about the healthcare system, medical. I mean, obviously, medical tourism, outbound medical tourism, is a big drain on Nigeria's resources, and I think Africa as a whole. And the pandemic has underscored some of the weaknesses in the public health system. What should African countries and Nigeria in particular be doing to improve the health sector so that we don't, in the next pandemic and just the public health and overall health in general is improved?
Andrew, I'm back on, by the way. I'm back on. Can you hear me now?
Volker,
yeah, I was.
Yeah. All right. So Volker, we'll put this question to you. So welcome back. So Edith asked about the healthcare system, medical tourism, people feeling middle class, upper middle class people not able to access what they want. What should the Nigerian government or other African countries be doing to respond, to take advantage of this, to improve both their general healthcare system and specifically their ability to deal with the next pandemic?
Well, obviously, right now, as Jesmin was saying, also the fiscal space right now in Nigeria is very, very low. It's non-existing. I think in terms of what could be done, you know, the IFC together with the World Bank, we have recently produced a number of what is called country private sector diagnostics, and one of the sector we have been looking at with great by ordinary citizens. I think this is an option that can be pursued, provided there was fiscal space. There are a number of countries that have been experimenting with to the extent that one encourages private healthcare also outside the big cities. I think such subsidies can help also lower middle income and other segments of the population to have access to these kind of facilities. But of course, right now this is very difficult.
Okay, so the next question is very, very right to the point from Ariti, which is what approach should the Nigerian government take to reduce the impact of COVID-19 on its economy in the long run? So, Jesmin, please, over to you.
So in the near term, I think the government focus should rightly be on containing the impact of the crisis. So for example, providing, supporting vulnerable households with targeted affected by the crisis, all of this stuff. And part of this is in the government program. Now, once the COVID crisis abates, then and things go back to reality, of course, reducing macroeconomic imbalances, will be very, very important. In Nigeria's case, what is most important would be to resume the domestic revenue mobilization, to build up the fiscal fort, to create policy space to address to many, many needs, and also at the same time, moving along on the unification of exchange rate, as well as providing greater flexibility. This has been our long-standing recommendation, and these are some of the commitments that are made in the letter of intent in our program as well.
Okay, Volker, what do you think the Nigerian government should be doing from an economic standpoint?
Yeah, thank you very much. First of all, as far as the short-term response is concerned, clearly right now containing the crisis, as Jesmin is saying. But I think, as I mentioned in my presentation also, we have been, World Bank, IMF, and many, everybody that I know in Nigeria among the policymakers has been urging for diversification of the economy away from oil, building the manufacturing base, building those sectors in which Nigeria has a comparative advantage. Justin Lin, who was the chief economist of the World Bank in 2000, up to 2012, and I wrote a paper about 8 or 9 years ago, which is called Growth Identification Facilitation Framework for Nigeria. And that paper shows a number of sectors in which Nigeria has a comparative advantage. That includes in the agribusiness area, in the light manufacturing area, in the rubber, so many sectors in which Nigeria could prosper, using not only the labor supply, but also the inputs that are widely available. And I have to say that many governors in Nigeria have been trying to build industrial parks, industrial zones. If one looks at Edo State, if one looks at Kaduna, if one looks at Kano, Lagos, of course, but these industrial zones have not really attracted the kind of foreign direct investors that would be needed to produce high-scale, high-end manufacturing of the kind in which Nigeria has a comparative advantage. And I think those efforts need to be scaled up, because Nigeria has the sector endowment to make all of this happen, and Nigeria has the domestic demand. This is very important, especially at this time of COVID crisis. Much of what could be produced in those industrial zones could actually be consumed domestically, and with reducing the logistics costs and so on. And so I think these are some of the countries like China and others are able to provide the required financing to create the infrastructure and move some of their manufacturing industries from China to Africa. This has been a long-standing mantra of the Chinese government, for example, and they are willing to support it. And I think the urgency of this has never been higher than in this moment where we don't know when the oil price, if the oil price will come back. And anyway, in the medium to long term, oil is not going to be a major source of revenue for Nigeria, as we are going into a less carbon-intensive way of producing and a carbon-intensive economy. And I think so. That's really, in my view, the urgency of this has never been higher, and I think many people are willing to help on that.
Thank you, Volker. Well, let's hope that Nigeria takes advantage of this oil price drop and finally does the diversification. As you rightly say, one unique feature of Nigeria is it has such a large domestic market that the classic theory of import substitution actually works for Nigeria. You're not replacing not replacing outside manufacturing with subscale domestic manufacturing. So you don't even have to export, you just need to replace the imports. Okay, so a bit of a sensitive question from Joseph. So we've been talking for years in Nigeria about the mining industry. The reality is there haven't been any, like I'm Canadian, world-class mining investments in there. We continue to have a lot of illegal mining, artisan on that. And Joseph also raises some sharp practices in the mining sector. What can the Nigerian government do to really get the mining industry going at scale? Maybe Jesmin, I'll ask you first your view on this.
So I will address it more from the perspective of FDI in general, because if the investors figure out what is the competitive advantage in a country. So I completely agree with Volker. The need for moving away from oil, whether it's another commodity or industrialization. But the thing that really, I used to work on Eastern Europe before moving to Nigeria. So those are the countries that actually thrived on FDI, and they have a completely different model of growth compared to Nigeria. And the big difference is the predictability of the predictability and regularity in the business environment that you need to provide to an investor. I think this is what Nigeria has huge potential in terms of domestic market, and in terms of resources, in terms of possibility to skill up the workforce, which the Eastern European countries, many of them don't have. They don't have the market size. But more than anything else, investors are very concerned about making sure that their investments are secure. They can take their money out if needed. The regulations are predictable. So those kind of nitty-gritty and business regulation environment will be very important if Nigeria is to really scale up its FDI, and it should, because the potential is just enormous.
Okay, so Tony has an interesting question. So one of the things we know about the Nigerian economy is perhaps 60% of it is in the informal sector. And of course, that's what we're suffering now from the high unemployment there. What should the government be thinking about in terms of the development of the informal sector, and possibly trying to bring the informal sector more into the formal sector, where you get higher productivity and investment potentially? But of course, to come into the informal sector, you need, or sort of formal sector, sorry, it needs to be attractive to people in the informal sector. So what should the government strategy be vis-a-vis a 60% GDP informal sector? Volker.
Yeah, thanks. Actually, this even links to the previous question about the mining. If I may just make a little point regarding a report, a study that we are about to finalize, which is called the Country Private Sector Diagnostics, which is soon going to be published, and which looks at the mining sector as one of the sectors, and that we think where Nigeria has tremendous opportunity. And we look at three measures, right, to promote mining. One is really develop a geodata policy and data protocols to support the transparent use of the dissemination of geodata to potential investors. There's a huge gap there. Secondly, develop an ecosystem of financing, especially for the leasing sector. I think lack of equipment is very important as a constraint. And here, leasing sector could be a major development of the leasing sector could be a major source of opportunity for Nigeria. And lastly, and that links to the question of the formalization, we also recommend formalize the artisanal mining, for example, through a gold purchase program, right? That's outlined in the report how that could be done. Now, the informal sector is the reason is why the question is, why do people stay informal? I think much of this has to do with the burden of registration, with the burden of paying taxes, with limited capacity to formalize. There are many strategies one can implement to reduce this. One can make it easier for businesses to register. One can simplify the taxation process. One can also highlight the benefits of formalization to small operators that, for example, they could have access more easily to microfinance programs, to other kind of loan programs when they're formalized. So these are all things, I think, strategies that could help in to formalize the economy. But I think at this point, one has to be also realistic. The informal sector, the large size of the informal sector has been a reality for Africa for a very long time, and it will continue to be a reality. I think the question really is, how can some of the large enterprises that are already operating in areas in which Nigeria has a latent or open comparative advantage, right? How can those companies become more larger players, both domestically and regionally, create employment, become a source of competitiveness? And I think here Nigeria has a unique advantage, because Nigeria is different from other countries in West Africa, has a very large formal sector that includes companies that are competitive. And I think here that advantage has never really been fully harnessed, and I think it could be harnessed through the appropriate policy mix.
Thank you for that. So we have a very good comment on the chat from Odeon, not so much a question, but really about the fact that countries need to come out of this pandemic much more resilient and able to, in effect, survive on their own. I mean, the wonderful thing about Nigeria, we all understand Nigeria has the potential to do all of these things, every single industry, agriculture, manufacturing, power, mining, etc. He also raises the issue of the importance of AFCFTA. We've advocated PwC consistently that the Africans need to work together to make Africa process. So thank you for that. I've only got time for one more question here, and I've taken them in order, so that I apologize to those whose questions won't be taken. But Igwan asks a very good question, which is, of course, there are lots of things that we thought we couldn't do before COVID-19, but with COVID-19, we're all learning to work in a different way. Even this session we're having today is an illustration of that, including the fact that it started on time, which doesn't always happen in Nigeria. So Igwan asks, we've been forced to deploy online learning, online telemedicine. So what are the opportunities to use these things in a much bigger way in sub-Saharan Africa, so that even when it's over, we can find new ways of delivering healthcare and education? Jesmin.
Actually, can Volker address this one? I'm new to Africa.
All right, well, Volker. So you're not new to Africa. So I know you enjoyed.
No.
Lagos. But
yes.
Yeah. So what's this going to mean for a place like Africa, where you always have this concept of leapfrogging? There was never the fixed telephony with straight. So now are we going to leapfrog and build our public health and health systems using telemedicine? Are we going to build education systems using distance learning with these technologies?
Well, I mean, this is an excellent question, I have to say. We are following also very closely India, right? Which has been, and if you look at some of the companies in India that have been working on online platforms, like food delivery or goods delivery and things like that, they have an increase of employment by a factor of 10. They have been growing very significantly, and I don't know to what extent that will be possible. Whether we have seen such signs in Africa. There is this firm called Jumia, for example, that has been working online. I think these are some. I think the question here is whether governments now use this crisis to unblock some of the obstacles to greater digitalization of the economy. There are, especially Nigeria has a very vibrant telecom sector, but there are obstacles to making it more widely available, including in remote areas, in rural areas, not only in Lagos or in Ibadan, but even more widely. I think that's one of the questions that one has to ask, because we don't know. Again, I come back to what I said at the very beginning. This is a time of incredible uncertainty. We don't know when we are coming out of this and how we are going to come out of this. What is the fact is that digitization has been an important priority and an imperative before the crisis. Is even more of a priority now. And that happens to be, I talked about the large enterprises in Nigeria that could be regional or even globally competitive. And telecom includes one of those. Telecom sector includes those large enterprises. So here's the question, how that could become a reality. And that could very well then lead to a kind of a leapfrogging undertaking, as you were describing.
Thank you, Volker. Okay, my severe apologies. We've come to the end of our time for questions, so I apologize to Ilya and Chidi, who had very good questions that we won't be able to fully address. At this stage, I'd like to ask Mr. Yemi Cardoso, who's founding director of the Africa Institute for Leadership and Public Administration, to give a summary of today's session and a vote of thanks. Yemi.
Thank you very much. Thank you. Can you hear me?
Yes,
we can hear you, Yemi. Yeah, yes.
Good. Thanks very much. Now, let me first of all say that from my perspective, as a result of the events of the past few weeks, there's been, like Volker and everybody has said, a considerable amount of uncertainty. And at the same time, there's been a lot of information that has been thrown out into the public space. Some relevant, some not so relevant, and some downright mischievous. Sad, because for many of the public, they sit down there and wonder, well, what does all this mean for us? What does the future have in store for us? How are we going to go past this huge and unprecedented period of uncertainty? At the same time, they're trying to figure out the new norm, carrying out the daunting task of combining professional and personal stresses. And frankly, it was with this in view that the Africa Institute for Leadership and Public Administration carefully chose the topic. And in considering those most qualified to talk on the topic, considered it was important to have individuals who had a mastery of the topic and could distill it down to its very basic details, considering the fact that we have a wide array of people here on this webinar from different countries, different continents, and different walks of life. I'm sure you'll agree with me that we've done an outstanding job of combining both Volker and Jesmin here today. And to both of you, I'd like to use this opportunity to thank you very much on behalf of all of us for taking the time to come here today and distill the topic the way you have. You've said a considerable amount, and I'm sure people will be very interested to have copies of your slides. And I won't go through too much, but to remind us of some of the things that were said, including the fact, importantly, that Nigeria and indeed most of the African countries approached the pandemic with built-in weaknesses. Very low growth, especially from the private sector, and structural imbalances generally. In the case of Nigeria, excess crude was used up. Very low collection. And in the case of Nigeria, relative to other parts of Africa, ours was even lower. We have one of the lowest collection to GDP rates on the continent. And of course, Fitch ratings generally have been on the downward spiral. And of course, with COVID, even worsened. And little investments, as I said, taking place. Of course, we listened to a general expose on what needs to be done. Okay, because a lot of these things we know were already there. Reduction in price of oil was already there and was accelerated by COVID, accelerated greatly by COVID. Frankly, what we heard today is something that we've always been aware of. We've always been aware of. But I think the message we got from the speakers today is time is of the essence. A situation where debt uses up much of our revenue. Debt servicing uses up much of our revenue. And we've always known that it was in the recent past about 60 to 70%. And from what we hear from Jesmin today, could actually go up to 100. Meaning that the government will have to borrow for everything else that it needs to do. So there's a very urgent need to diversify the revenue. We've always known that, we've always heard it, but I think it is critical now, ever than before, from what we've heard today, that we've got to get our skates on in this direction very quickly. Due cognizance, of course, was given for ease of doing business, which has improved considerably. It's still a way to go. We also heard about the opportunities for diversification through manufacturing. we had a strong case being made for Nigeria focusing on its comparative advantage and using everything possible to take its comparative advantage to a level where it can now begin to fill the vacuum for manufacturing. It has relatively low cost of labor. And as we've seen, and as we all know, with adjustment in prices, we should be more globally competitive, taking into consideration other factors, of course, power, etc., etc. These are all things that all go in together. But however, that not of our revenue. I think that sums it up. I want to thank everybody. I want to also say something about the Africa Institute on Leadership and Public Administration, which is located in a state-of-the-art digital research center in the University of Lagos called the Arthur Mbanefo Digital Research Center. Of course, with the way COVID has moved training these days, we're doing this virtually, and indeed, we will do more of these kinds of sessions virtually. Before I round up and thank all of you for your participation and taking the time from your busy schedules to come and participate on this event, I want to, in particular, thank Jesmin and to welcome her, because this is the first time, as you are hearing, transiting to Nigeria, to thank and to welcome you as you take on the great challenge of what you are doing on the continent in general and Nigeria in particular over the next couple of years. And to also, in particular, thank Volker, who at a relatively ungodly time, quite frankly, agreed to come and participate in this event today. He's dialing in from Washington, D.C., and I know time-wise it's not the best. But from what we've heard today, it is clear that he has a great grasp of the goings-on. Two things before we finally sign off, and one of them was actually said by Jesmin. I would recommend, as much as possible, as we go forward, the coronavirus, we know what the issues are. We see it on television every day. And it doesn't need a genius to know that we're going into a relatively challenging period ahead. I'm not going to talk about the normal things about washing your hands, etc., because I know an audience like this knows that. But one thing I would like to mention, de-densify your environment. De-densify your environment. Separate people as much as possible. The more we can separate ourselves, the less likely it will spread. What do I mean by this? If we're going back to work, which we have to, please bear this in mind. De-densify your environment as much as possible. Keep that in mind, because it is easy to go back to work and everybody clusters. It must be something that we have at the back of our minds all the time. Secondly, and something that was said by Jesmin, now more than ever before, we must do what we can to protect the vulnerable and the weak. Define it in whichever way you want, and really it is up to you to define it, the vulnerable and the weak. But we must do everything possible to protect them. They are the ones that at the end of the day get the shorter end of the stick at a time like this. And they need us as much as possible. So without further ado, I'd like to thank all of you, to thank the moderator for his very, very, very hard work, and to Nevin, and to thank the speakers, and to thank all that participated in this today. And of course, Mamu, who's always there in the background. Thanks very much, and have a good
Thank you, Jesmin.